Welcome back to the Deep Dive. We're the place you turn to when you want to cut through all that noise, that information overload we all face, and get straight to the insights that matter. And for you, our dedicated MBA candidate listener, first off, a sincere apology from us. We know it's been a bit longer than usual between deep
Yeah,
dives.
we really wanted to take a beat.
Exactly. We decided to spend a little extra time, digging through potential sources to find the absolute best, most insightful books to really fuel these conversations. We think you'll find it was worth the wait. So today we are plunging into a topic that honestly couldn't be more critical right now. Financial risk management. Next generation techniques.
Hmm.
We've basically taken a really comprehensive source and boiled it down. We're pulling out the core ideas, some surprising facts, stuff that might genuinely change how you think about managing uncertainty.
Yeah, think of it as your inside track to understanding financial stability today.
Because let's face it, financial market turmoil, it's not exactly new, is it?
Oh, not at all. I mean, if you look back centuries of it, you've got irrational behavior from investors, from management. Think about the Dutch tulip craze back in the 1630s.
Right, the classic example.
Or, much more recently, the housing price bubble in the 2000s. And the thing is, despite all the rules, all the regulations we put in place, this kind of turmoil, frankly, it's going to keep happening.
So the pressure's really on the people at the top.
Absolutely.
Right.
The onus is squarely on corporate execs, on their boards, to actually manage this risk effectively. It's a constant battle, and the stakes, always high.
Okay, so that leads to the big question, isn't it? We've had centuries of this turmoil. We've built entire disciplines around managing risk. So why did these massive crises still happen? Were the old ways just not good enough, or was something missing?
That's the million-dollar question, isn't it? The discipline itself has certainly evolved. I mean, you had thinkers like Frank Knight way back
Right.
making that key distinction between risk, something you can actually measure, put a number on.
Viable, yeah.
Right. And uncertainty, which is, the stuff you can't easily measure.
Yeah.
And then John Maynard Keynes, he really emphasized judgment. He warned against relying too much on the numbers, that false sense of security they can give. Then jump forward to the 1980s, you see these new risk societies popping up, like the Society for Risk Analysis. And by the 90s, the idea of a chief risk officer, a CRO,
Right.
that emerges. GE Capital was actually the first, creating a role specifically for managing total risk across the whole company.
Okay, so it sounds like, on paper at least, huge progress was being made. Dedicated roles, refined concepts.
Absolutely.
So then how do we explain 2007, 2008, the global financial crisis? Why were the world's biggest banks, their regulators, even their auditors, why were they so catastrophically wrong about the subprime mortgage market?
Well, according to the source material we're looking at, a big part of the answer lies in the failure to use what they call next-generation techniques.
Oh.
And what's really fascinating, I think, are the stories they tell about those who did go against the grain, who defied conventional wisdom, and, well, they survived, or even thrived.
Like who?
Think way back, like Noah building the ark when everyone else thought he was crazy.
Right.
No flood coming. Or Toyota developing the Prius. Remember when everyone was obsessed with gas guzzlers?
Yeah, hybrids seem like a niche thing then.
Exactly. And closer to finance, Wells Fargo. They famously decided not to jump into marketing subprime loans. Turned out to be an incredibly smart, prescient move.
Those are really interesting examples. But I mean, is it really fair to compare building an arc or even developing a new car to the complexities of financial derivatives in global markets? Are those lessons truly transferable, or is there maybe a bit of hindsight bias there?
That's a totally fair point to raise, but I think the source argues these aren't just, lucky one-offs. They reveal something deeper, something that does apply across different fields. See, next-gen risk management, the way they frame it, isn't really about having a perfect crystal ball. That's impossible. It's more about building a culture within the organization,
A culture that does what?
a culture that questions things deeply, that resists just going along with the crowd, groupthink, that actually values the contrarian view, even when it's unpopular or uncomfortable.
So listening to the dissenters, almost.
Precisely. That ability to challenge your own assumptions, to really hear the quiet what if in the room, that's the ultimate survival tool. And that applies whether you're a tiny startup or a massive global bank.
That's a powerful idea, and it really does feel like it goes beyond just finance, right? For you listening, learning from history, constantly challenging assumptions, that feels crucial for navigating today's world, not just finance, and avoiding becoming, as they put it, an economic casualty.
Okay, let's unpack this a bit more then. A really fundamental point in our source material is the critical role of data. Data and quality control. This seems like the foundation for everything else we're going to talk about. Oh, absolutely. Data governance, DG, in financial risk management it's paramount. You have to see data not just as information, but as a major asset or potentially a huge liability, depending entirely on how you manage it.
So it's not passive, it's active management.
Exactly. The real insight, I think, is that DG isn't just about tidying up your spreadsheets. It's about building a core capability. It transforms data from something that could trip you up into a strategic asset, almost like an early warning system.
Okay.
And setting up a data governance center of excellence, a DG COE, that's like the nerve center for this whole thing. It ensures consistency, quality, strategic alignment. And having a maturity model gives you a roadmap, right? So you can continuously improve how smart your firm is with its data.
But it sounds like a lot of firms aren't quite there yet.
Well, yeah, the surveys mentioned show some pretty common challenges. Surprisingly, only about a quarter of firms apparently have central ownership of their data. And only about half have defined key performance indicators, KPIs, to even track if their DD efforts are successful.
Wow. So there's a big gap between knowing it's important and actually doing it effectively.
That's right, a widespread gap.
So what are some of the practical things firms can do? What are the best practices or source highlights for improving data governance? Because it sounds like a real opportunity.
Yeah, they list several key ones. First, prioritize data. Sounds obvious, but you really need to figure out the value and the risk associated with different types of data. That way you can put your resources where they matter most. Not all data is created equal.
All right. Focus your efforts.
Second, eliminate paper. As much as possible, digitize documents. And importantly, destroy the physical originals unless there's a legal reason not to. This cuts costs, saves space, and honestly makes things like legal discovery way less painful.
Makes sense.
Third, federate content. This is about being able to access and link data, even if it lives in different places, different databases, creating a kind of virtual data repository.
Like the bank example you mentioned earlier. Seeing all of the customer's accounts at once.
Exactly that, even if savings, checking, credit cards are in totally separate systems. Fourth, expand worm technology. That's write once, read many. It ensures records can't be changed without authorization or documentation. Crucial for data integrity, especially in regulated industries.
Got it, worm.
And finally, really expand the use of business process management, BPM, and workflows. Especially when you combine these with Lean Six Sigma principles, they streamline things, automate tasks and approvals, and create these clear, transparent audit trails. It dramatically improves governance and consistency.
Okay, and all of this, the governance, the processes, it ties directly into operational risk and the quality of the data itself, doesn't it? Feels like this is how you prevent those unexpected errors from creeping in.
Precisely. Poor data quality isn't just annoying. It leads to real financial hits, risk management failures, compliance breaches. It's not just about getting a number slightly wrong. It could, jeopardize regulatory standing or lead to huge revenue leaks.
So what are the key dimensions of data quality they talk about?
Our sources detail a few key ones you have to manage actively. Accuracy, does the data actually reflect the real thing, the real person, the real transaction? Completeness, are all the fields you expect to be actually filled in.
Okay.
Consistency, this is important. Are the values the same across different systems or reports or over time? This is different from accuracy, right?
Yeah.
Data could be consistently wrong.
Ah, good distinction.
Then reasonableness, does the data make sense in context? Like, sales figures shouldn't suddenly jump 500% compared to history without a good reason. And finally, uniqueness, making sure you don't have accidental duplicate records messing things up. It's really a multifaceted view of data integrity.
This focus on quality, defects, process control, it really does echo that whole movement in manufacturing, doesn't it? Total quality management, TQM, Lean Six Sigma.
Spot on.
You trace it back to Walter Shehart and statistical process control in the 20s, then the Japanese quality revolution, Toyota production system, then the US catching up with things like ISO 9000 and Six Sigma.
That's exactly the lineage. And Six Sigma, its big goal is that famous number, reducing defects down to just 3.4 per million opportunities, making things better, cheaper, and faster.
And it's not just for factories anymore.
Absolutely not. Its applicability in financial services is huge. It gives you a really structured way to improve processes continuously, whether you're, processing loan applications or managing complex trades.
Okay.
And to really get at what customers need, which drives quality targets the source brings in Kano's model. It's a great way to think about customer requirements. They're the unspoken, assumed things, the basic expectations.
Like my banking app should work.
Right. Then the spoken requirements, the things
Mhm.
people ask for, where better performance leads to more satisfaction. And then the really interesting ones, the love-to-have features, the unexpected delights that can dramatically boost satisfaction.
Ah, the differentiators.
Exactly. And meeting those unspoken assumed needs and maybe hitting some of those love-to-have ones, that gives you a serious competitive edge, finance included.
So it really hammers home that proactive data governance and quality aren't just about ticking compliance boxes or avoiding fines. They're fundamental to cutting liabilities, boosting efficiency, and even understanding and delighting your customers in ways they didn't expect. Foundational stuff for anyone thinking about ops or strategy.
Okay, this is fascinating. Let's shift gears now to the really cutting-edge stuff. What are some of these next-generation techniques that our source believes can fundamentally change the game in risk mitigation? What are the truly innovative tools coming online?
Yeah, this is where it gets really interesting, as you say. One powerful tool they highlight is using Bayesian networks for root cause analysis.
Okay, Bayesian networks. What are they, in simple terms?
Think of them as graphical models. They map out relationships between different variables, but crucially, they integrate probabilities. They're used in really complex situations like medical diagnosis or even criminal forensics to figure out
And
likelihoods.
in finance? In finance, they're emerging as a way to pinpoint why processes fail, even when you don't have all the data. They go beyond simpler tools, like, say, fault trees or fishbone diagrams, because they can actually calculate the probability of different causes. It gives you a much more robust handle on the why.
Could you give us a quick example? How does that probabilistic part make a difference compared to just a standard flowchart?
Sure. A standard flowchart might say, if step A works, go to B. If B fails, trigger C.
Right.
A sequence.
Yeah.
A Bayesian network could tell you, okay, step B failed. Given this failure, there's 80% chance the root cause was a problem back in step A, but maybe a 20% chance it was due to a faulty external data feed. It assigns likelihoods, even with incomplete information. That's incredibly powerful for complex financial systems where things aren't always clear-cut.
Got it. That makes sense. What else?
Then there's predictive analytics. This is huge. It's about moving beyond just looking backward, analyzing what happened, to understanding what's happening right now, and the really key part, predicting what will happen.
And what makes that possible?
It relies on a few key enabling technologies. Data mining, digging through both structured data like spreadsheets and unstructured text like emails or reports. Machine learning, which allows systems to learn from experience, adapt to new information without being explicitly reprogrammed. And visualization, tools that help humans actually see and understand the complex patterns the machines find.
Can you give an example in finance?
Sure, think about traders. They could use predictive analytics in real time to choose who to trade with their counterparty selection, based not just on credit ratings, but maybe on predicted operational expertise or short-term financial strength indicators derived from multiple data sources. That gives them a massive edge by assessing risk before the trade happens.
Wow. Okay. Real-time risk assessment.
Exactly. And building on that predictive idea, there's environmental consistency confidence, or DECC, and predicted key risk indicators, PKRIs. This is basically applying the scientific method to financial risk. The core idea is pretty compelling. If you can actually predict incidents and losses with some degree of confidence, then you have some real ability to manage your risks.
It's about moving beyond just tracking metrics.
So correlation isn't causation, but
But, as the source insightfully puts it, correlation should cause questions. A key risk indicator, a KRI, shouldn't just be an interesting theory. It has to have demonstrable predictive power for estimating potential losses.
any examples of that?
Yeah, they mention a case study of a global commodities firm. They found that days with really high trading volume and high complexity consistently correlated with higher operational losses later on. Identifying that predictive link allows them to proactively manage resources or adjust controls on those specific types of days. It helps find the true drivers of risk.
This also seems to connect to another evolution mentioned, moving beyond just traditional segregation of duties, or SOD.
To thinking about broader user access control risks. If the old SOD model, basically, making sure no one person can do two conflicting things isn't enough, what's it missing? What are these single function risks?
That's a really critical point the source makes. The old SOD model is necessary, but not sufficient. Because risk isn't always about two people colluding or one person doing two bad things.
Okay.
There's significant risks where just one function, one permission, is incredibly dangerous. Think about someone having direct access to sensitive data like customer bank account details, one person, one permission, potentially huge damage.
Right.
And furthermore, the source really stresses the importance of looking at submaterial fraud. This is fraud that's maybe too small to affect the overall financial statement, so it often flies under the radar of traditional audit.
It's still important.
Absolutely critical. It's not just about the dollar amount, which might be small initially. It's a massive red flag. It signals deeper weaknesses in your controls, maybe cultural issues. It erodes trust, damages reputation over time, and frankly, it can create pathways for much bigger systemic fraud down the line. You need to catch those small cracks before they become huge fissures.
And what does all this imply for the technology side, for the ERP systems, enterprise resource planning software that companies rely on?
It means the vendors of that software really need to step up and evolve their applications. They need to provide much finer control, more granularity in their security settings, their permissions.
So more detailed user rules?
Exactly. And more automated controls built right in.
Yeah.
Things like flexible workflow processes that have approvals and audit trails embedded from the start. It's about building prevention into the system design, not just relying on detective controls or audits after the fact to catch these more nuanced, often hidden risks.
So stepping back, adopting these more sophisticated, data-driven tools, Bayesian networks, predictive analytics, nuanced access controls allows you, the listener, to be much more proactive, to find those hidden vulnerabilities before they cause damage, and gain a real strategic advantage in managing risk. It's a shift from reactive firefighting to genuinely strategic foresight.
Okay, so we've talked about data, quality, next-gen tools. What does this all mean for the organization as a whole? How do we pull all these pieces together for a truly holistic view? Because often, risk management can feel very siloed, right? Different departments looking at different things.
That's a key challenge, integrating it all. And to tackle that, our sources introduce a concept called transaction-based cross-enterprise risk management.
Okay, that's a mouthful. Break it down for us.
Think about the Basel II regulations, which mandated banks hold capital against operational risk. That was a huge headache for banks because operational risk data was all over the place, fragmented, often qualitative, stuck in different departmental silos.
Right, hard to add up. Exactly. So this approach offers a potential breakthrough. It proposes using something called enterprise risk units, or ERUs. Think of these as standardized common units of risk measurement.
Like a universal currency for risk.
Sort of, yeah. And the idea is you attach an ERU value to every single transaction as it enters the system. Then you combine that ERU value with a score representing how well the controls around that transaction adhere to best practices. They call this percent best practice, or percent BP.
Okay.
When you combine these two, the ERU per transaction and the percent BP for the causal factors, it allows you to do loss predictive modeling in real time, or very close to it, across the entire enterprise.
So it provides that integrated view you couldn't get before.
Precisely. It's potentially a vastly superior way to see the big picture compared to trying to stitch together risk assessments from different silos after the fact. It could be a real game changer for aggregating risk across complex organizations.
Interesting. What other frameworks help with this holistic view?
Another really powerful one they discuss is throughput accounting. This comes from Eliyahu Goldrat's Theory of Constraints.
A goal, right, that book.
That's the one. Throughput accounting simplifies financial measurement down to just three core elements. First is throughput, which is basically sales revenue minus your truly variable costs like raw materials. It's the money the system generates and retains from selling its products or services.
Okay, money coming in and staying in.
Right. Second is investment. All the money tied up in the system to generate that throughput. The inventory, buildings, equipment, money stuck inside.
Got it.
And third is operating expense. Basically, all the other money the system spends to turn investment into throughput. Salaries, rent, utilities, money going out.
So throughput, investment, operating expense, TI, and OE. How does that help strategically?
The genius of it is its focus.
Yeah.
It forces you to identify the system's main constraint, the bottleneck, the thing holding back overall performance, and then you focus all your efforts on exploiting or improving that constraint. Analyzing decisions through the lens of TI and OE can radically change your perspective. Should we outsource this function? Add this new product? Make this capital investment? Spend money on this process improvement? You evaluate each decision based on how it impacts throughput, investment, and operating expense, specifically aiming to maximize net income by leveraging that key constraint. a fundamentally different, often counterintuitive way to look at profitability and guide strategic choices.
And it's stressed that these ideas aren't just for, say, the manufacturing floor or the back office, right? There's specific mention of quality in the front office.
Absolutely. These principles, process improvement, data quality, constraint management, they're directly applicable to high-stakes environments like financial trading firms.
They even mention a framework, PBDC.
Yeah, plan, benchmark, do, check. It's essentially an iterative cycle for continuous improvement, specifically tailored for quantitative systems, like training algorithms. It's not just a one-off check. It's the operational rhythm for quants. They constantly plan improvements, benchmark against expectations, implement changes, and then check the results, learning from every market move, every trade.
So it's about constant refinement.
Exactly. And when you combine these different frameworks, the transaction-based risk units, the throughput accounting focus, the continuous quality cycles like PBDC, that's how organizations can really move beyond being reactive and siloed in their risk management.
Towards something more strategic.
Yes, towards a truly strategic, integrated approach that doesn't just manage risk, but actually optimizes overall performance and ensures the organization is viable for the long haul. It's about seeing the whole system, understanding how the parts interact, not just focusing on individual components in isolation.
So for you, our listener, applying these integrated frameworks isn't just theoretical. It can give you a much deeper, enterprise-wide understanding of risks. It helps you figure out where to put resources most effectively and lets you make genuinely data-driven decisions that smartly balance the potential upsides with the potential downsides. This is the kind of thinking that can really differentiate you. So as we wrap up this deep dive, we've really covered a lot of ground, haven't we? We've journeyed through this evolving landscape of financial risk management,
Yeah?
from acknowledging its deep historical roots, the centuries of booms and busts,
Mm-hmm.
all the way to these modern frontiers driven by data, by sophisticated analytics, by an almost scientific approach to uncertainty.
And I think the core message that really comes through from the source material is clear.
Mm-hmm.
Effective risk management today, it isn't just about dodging disasters or, keeping the regulators happy.
It's more proactive than that.
Much more. It's actually about being an innovator. It's about finding ways to achieve a real strategic edge over competitors. And fundamentally, it's about ensuring the organization's very survival in an uncertain world.
So it's not a static thing, it's ongoing.
Absolutely. It's this continuous, dynamic process of learning, adapting, constantly questioning your assumptions, and refining the tools you use. It's a living, breathing discipline, really.
So here's a final thought for you to take away and maybe mull over. Consider this. If risk is really just uncertainty that we can measure or at least estimate, what uncertainties in your own life or perhaps in your work are you currently treating as completely unmeasurable, as just bad luck waiting to happen? And what new tools or perspectives, maybe some we've touched on today, could help you start turning those uncertainties into risks you can actually understand and manage?